Welcome back to the 444 Studios. Man, what a day. Actually, what a week, because it wasn't just today. The stock market is breaking records, but in the wrong direction. I hope for your sake that you are a casual investor who only glances at their portfolio like once or twice a month, because following it daily lately has been insane, not for the faint of heart. So, what we're going to do today is first, we're going to analyze the damage, the impact, then we're going to assess the damage. And then I'm going to show you what I have been doing the last couple of days, how I've been positioning my chessboard, my portfolio, as far as options go and whatnot, and all the moves I made. But wow, wow, that's all I have to say. So today is April 4th, Friday, 2025. Tariffs went live like 2 days ago. And ever since then, it's been a bloodbath. Now, this is a snapshot, the heat map from today. And as you can see, everything is red. And even the stocks that are green, like Nike, for example, were actually down horrendous yesterday. So now they're just making up a tiny bit of, losses, but they're still red on the last like 2 days. So literally everything is red. And here's a good quote that I like from, I don't know if it's Howard Marks or whoever it is. In times of crisis, all correlations go to one. What does that mean? That things that are not correlated, such as, I don't know, Google and healthcare, or Dunkin' Donuts and cybersecurity, right? Even though they shouldn't be correlated, they shouldn't be moving in the same exact direction based on like one specific headline, they are, which means one thing, it's a psychological market swing, right? Market is emotional, and today it's like 98% emotional. Well, the last 2 days, really, it's like 98% emotional. And in times like this, I hate to say the cliche, but opportunities are everywhere. Now, in the video I posted like a week ago, I told you during the mid-March dip, don't buy the dip yet, right? Because now you start buying the dip. When the S&P 500 is down on the 1 year, we're officially red on the 1 year, trailing 12 months. When you zoom out to 5 years and it kind of looks like a pretty scary cliff, okay, now it's safe to start making some moves and allocating some dry powder, right? Because if we go to, let's go year to date, the mid-March dip, which was like here, like around this area, it was still kind of scary because we had like a lot of things piling up. Deep seek sell-off in January, tariff rumors, everything, or headlines were starting to pile up. But like I said in that one video, right? That one big dip is always around the corner. It's never the obvious one. And yeah, the last 2 days kind of proved that. I mean, we fell off a cliff. So I'm going to start the video off before we start assessing the damage and get into the plays. I'm going to start us off with this quote from my boy Howard Marks. The one thing I'm sure of is that by the time the knife has stopped falling, the dust has settled, and the uncertainty has been resolved, there will be no great bargains left. When buying something has become comfortable again, its price will no longer be so low that it's a great bargain, right? So in the next weeks, months, you're going to hear a lot of people say, I'm not catching a falling knife. I'm waiting for the dust to settle, which is fine, right? It's not for everybody to take enormous risks, but here's the one thing, right? If you wait for the dust to settle like everybody else and wait for the confirmation that we're back again and things are recovering, well, at that point, like he said, when things are comfortable to buy again, when you're like comfortably pressing the buy button, you're not really, like, the risk is already gone. And when the risk is gone, for the most part, that means the above average rewards are also gone. So keep that in mind, right? I don't know what kind of investor is watching this on the other side of the computer or phone, but if you want above average gains, you got to take above average risks. Now, I'm not telling you to buy the entire dip in one shot, but on days like today, you have to do something. You have to act. If you're not acting when the fear and greed index is at the literal lowest it's been in, here it is right here, the lowest it's been in over a year. Let's see, actually. No, even in 2022, it did not get this low. Okay, it got a little lower, right? Peak 2022, which was like one of the worst market drawdowns in recent history, right? I can't wait to get into like why the market is not as bad as it seems, but okay. So pulling up Wikipedia. So I got curious because today we're down 6%. S&P is down 6%. And yesterday, I think we finished the day down like 4.5%, something like that. So two back-to-back really bad days. So I was like, hey, what's the largest daily percentage losses in the last like 10, 20 years? And did we just make the list for like the top 10 or top 20? So looking right here, looks like 1987 was a 20% single day drop in the S&P, which is nuts. That's like 4 times worse than today, but yeah, different times. So the good news is that we're not in the top 20 for today, April 4th, 2025. We had a really bloody day, but it wasn't bloody enough to make the top 20 worst days of all time. And it stops at 20, but if I had to guess, we're probably in like the top 30, maybe. In recent history, the pandemic year, 2020, is on here twice. So in the third spot, which was down 12% in one day, and the sixth spot down 9.5% in one day. All right, so yeah, today sucked. Thursday did too, but it's not like Guinness World Records type of drawdown. So we'll take it. But yeah, something's happening. Another cool statistic to know, it's important to know, especially this one, is that every single year in history has had an intra-year drawdown, right? Which means the market goes down all the time, not only up. Even the years that it goes up a lot, somewhere in that year, it has a moment where it falls, and sometimes a lot, but it still ends up green, right? For most years. So the average intra-year drawdown since 1928 is 13%. So even if look at 2020, right? It ended the year, the total return for that year was 18%, which is really good. But somewhere in there, and we know during March, during the COVID pandemic quarantine drop, there was a 33% drop from peak to bottom within this year. But it still ended up the year giving a total return of 18%, right? So every single year, there's going to be an intra-year drawdown, some years bigger than others, but on average, it's going to be around 13%. So what are we at this year? Well, let's have a look. Year to date, we are about, actually, let me open SPY. Let's go year to date, and let's find the peak, which was like, yeah, my portfolio peaked at like February 19th, definitely. So we are 17.5% from the peak of 2025 to the current bottom. Now, will this get worse? Maybe. Will it shrink and start trending upwards? Maybe. But right now, we are in the above average territory for the intra-year drawdown. In 2022, the intra-year drawdown was the biggest since COVID, and that was down 25%. So at 17.5, it's especially this early on, yeah, well, we'll see. There's no clear black and white indicator on what that means, but it means we're in above average bearish territory, right? That's all we can really take away from that. Yeah, so this is my miscellaneous database where we have any type of watch lists you can think of: robotics, energy, commodities, blah blah blah. And this is the homepage. So this is not so great. I'm looking at all the different sectors up here, right? We have technology, financials, healthcare, industrials, consumer, energy, blah blah blah. All of them were red today, and basically on the 5-day, on the 1 month, on the 3 month, and year to date. So every sector besides consumer staples, and you can argue industrials, but we'll just stick to this. Every sector is having a terrible year, which is not great, right? That's another little red flag there. So, and if consumer staples is flat or steady, that usually means people are set on, this is not saying like this is the case, but this is how people are thinking because they're showing it in the actual market. This is like the typical recession market action, right? Flee to like consumer staples that are safe during times of like turbulence, and everything else kind of just bleeds, right? Fear and greed index, like we already saw, is at like 3-year lows. The US dollar obviously has been fluctuating a lot due to this trade war. The volatility index, the VIX, for those that don't know, is like a measure of how volatile the stock market is on like a day-to-day basis. So when this is high, things are a little bloody, things are a little uncertain, turbulent, et cetera, et cetera. So being at 50%, yeah, that's pretty high. So we got all the red flags basically lining up. And then I'm not going to go over the basis trade, but that's another like over leveraged hedge fund potential headwind that could mess things up. I hate those hedge funds, man. They always go leverage. They always, you know, there's talks of like a bailout, whatever. One of the interesting things from these tariffs is Vietnam and Cambodia getting hit with tariffs. Now you're probably wondering, why does that matter, right? Vietnam and Cambodia, they're not talked about much. Well, in the 2018 and 19 tariff trade war, when the US hit China with tariffs and started this whole like uncertainty around doing business in and out of China, well, a lot of companies like the ones listed here, Nike, Lululemon, Under Armour, Skechers, etc., had a majority of their manufacturing getting that cheap labor from China, right? As everybody kind of tends to. But in 2018, they saw that little scare. They got a little jump scare and decided, okay, let's reroute our manufacturing so that we're not relying on China, because if these tariffs actually, really kick up like next year, the year after, we're going to be screwed, right? So they moved a lot of their manufacturing to Vietnam and Cambodia, because the US is not really taxing them on importing goods. So they can make their cheap goods, still get that cheap labor, and import their Nike shoes, the Air Forces, your whatever, your Burberry, your cosmetics, and kind of circumvent that Chinese tariffs and that like tension between the US and China. But now Vietnam and Cambodia get hit with tariffs, right? So now, those companies are like scrambling, like, oh shit. So that's why I made this list of Vietnam and Cambodia manufacturing tariff victims, because it's an interesting follow. And a lot of these names are already beat up a lot this year. And because of this tariff headwind for them between Vietnam and Cambodia, keep an eye, screenshot this list, because I feel like this year, some of these names are going to get beat up so good that they're going to be amazing bargains. Probably Nike is my top pick if I had to guess. I just like Nike in general. I'm always wearing Nike. But yeah, even Apple, the big dogs aren't. I actually saw a headline that they're scrambling to move manufacturing to Brazil now. That's what businesses do, guys, right? It's never as bad as it seems. It's never as good as it seems. Businesses they're created to jump hurdles and put out fires. That's what a business is. So they're always going to reroute. They're always going to figure out a way, and those that don't, their competitor will. So they're all incentivized to, do their best to jump over every hurdle that's presented. If you want, if you don't want to screenshot this, jump over to 444 Capital, where, we have all the resources. We are in the community. Link will be in the description if you want to come in. But, this is one of our databases where, you can see at the bottom, right? We got luxury products. We got a tab for luxury products. We have a tab for Japan and China. So Chinese stocks were also down horrendous today. But yeah, this is one of my favorite resources that I've put together for us. Okay, now what's next? So Vietnam, Cambodia, right? What's going to happen? There's going to be a lot of bargains within these names, in my opinion, but we're already kind of seeing the potential deals being talked about. So this headline, Trump says Vietnam's president told him they will cut tariffs to zero if they can make a deal with the US. So I also saw a similar headline for Cambodia, and I imagine like countries are going to just want to press the easiest pain release valve is to just say, we'll make a deal. Let's drop these tariffs. We've had these tariffs on the US. We're going to drop ours now that you've put reciprocal tariffs, and let's just make a better deal because this is causing too much pain. So I feel like a lot of countries you're going to start seeing the headlines. Like give it a week, give it 2 weeks, you're going to see them. So the longer we wait though, I feel like the more that these victim stocks will get beat up. So you might want to grab some if you're interested in this sector, or you want to play that tariff arbitrage game, because there's going to be a lot of panic, and there already is, right? Okay, the next thing I want to talk about is this drawdown for the S&P 500 as bad as it seems? So everybody, for those that don't know, the S&P 500 is a basket of the top 500 companies publicly traded, which it's not just one criteria. It's not just size. It's like profitability, growth, revenue, but it's like the best of the best, right? Out of the thousands of companies out there in the world that make $1 billion or more a year in revenue, only 500 of those were selected and are selected every quarter for this basket. So everybody uses this as like a benchmark for the stock market. You could basically call the stock market the S&P 500. So the S&P was down 6% today. and year to date down 14%. But is it really, does that really indicate how bad the stock market is doing? The answer is no. And here's a why, which a few people talk about this, but not enough. So remember I said it's a basket of 500 companies? Well, just seven companies of the 500 make up a total 34.5%. So almost 35% of the entire basket is made up by just seven companies, and that's the Mag 7, right? NVIDIA, Microsoft, Amazon, Tesla, Google. So that's a lot, right? And these Mag 7 have had pretty brutal drawdowns year to date since 2025 started, which is kind of giving like a skewed performance for the S&P 500, because in reality a majority of this drawdown is coming from like seven companies, right? And if we say just the top 10 companies in the basket, we're now probably talking like 45%. So damn near half of this index of 500 companies is being skewed way to the right, way down by just like a handful of like 7 to 10 companies, right? So if you pull up, do I have this pulled up? So there's an equal weight index of the S&P, SPX equal weight. And instead of having like, let's say right now in the S&P, Facebook will have 8%, NVIDIA will have 3%, and they attach weights to each one of the companies in there. But the equal weight index just makes everything equal. So Facebook, Meta, NVIDIA, a smaller company that's like in healthcare, they're all gonna have like, let's say 0.25% or something. So the equal weight index is actually down a little less, as you can see today, 4.79 versus 6%. So that's showing you that skew is adding almost 50% to the downside, right? So that's something to kind of keep in the back of your mind. So is it really the whole stock market that's shitting the bed? Or is it these like 7 to 10 companies that are down bad in 2025 that are kind of pulling it, dragging it, everything else down and making it look really bad? Yeah, let me pull up my tweet. Okay, so I went back to 2022 and kind of analyzed the Mag 7, or like the big tech, and how much that big tech bleed in 2022, the drawdowns that happened from like top to bottom, and then compare them to today. So if you're looking at it, almost on all of the big tech names, except for Netflix, of course, today, like present day in 2025, we're almost halfway to the big drawdowns of 2022. And 2022 was insane, like unbelievable. The biggest names out there had drawdowns in the 30, 40, 50, 60, 70%, right? Google down 40 in 2022. NVIDIA was down 64%. Amazon was down 54%, right? From peak to bottom. Tesla was down 70, Meta 73, Netflix 75. Now, I literally made money from almost all these names by buying the 2022 bleed. So these four, definitely. Google and maybe Microsoft, I don't remember. So let's say 5 of these, like 7 or 8, I made really good returns, like 100%. I doubled my money or more on every single one of them. That's how amazing, that's how easy it was. But again, it wasn't comfortable to make those buys, right? Once it got comfortable, right? Once Amazon was back above, 150, and Tesla was back to 200, then it was comfortable. But by then, it already doubled off the bottom, right? Like people like me who took advantage were already up 2x. So going back to present day, right now, I don't want to call this pure bargain territory, but we're damn close. We're damn close. So pick your favorite names, have your watch lists. If you're in 444, luckily you have all of our watch lists in our databases, and you have the big ideas vault. So the bargains are coming, they'll come to you. But on days like today, I sure as hell hope you made some type of move, because, if not today, when? If you're not going to make a move when the fear and greed index is at, 5-year lows, 4 or 5-year lows, half a decade lows, when are you going to do it? So that's a little motivation from me. Also, right, going back to the weights. So it's literally like when people refer to the stock market, it's the S&P 500 and QQQ, or the NASDAQ, right? So those are the two names you hear. But QQQ, which represents mostly tech companies, 50% of QQQ, which is like the NASDAQ, is made up of the top of just 10 companies, right? 10 companies out of what, 100? NASDAQ 100. So 10 companies make up half of the entire ETF, right? So keep that in mind, because a lot of these companies are taking big hits and they're dragging everything down. So you have QQQ, the NASDAQ, being dragged down by just a handful of companies, and those same companies dragging down the S&P, and it just looks like an extreme bloodbath. But in reality, like, yeah, it's still bad, but it's considerably less bad than it looks when you kind of have this context, right? So please share that with your friends and let them know, or whoever, the people you trade with, et cetera, et cetera. Okay, so what moves have I made? So luckily, I made a video, like 2 videos ago, where I deposited like $125,000 into my Robinhood because I knew shit was about to get real. And was that in like February, early March? I don't remember the exact date. But I have been active, mostly on the options side. Now, I haven't been doing degenerate call options, right? What I have been doing is credit spreads, cash secured puts, and covered calls. So I'm not going to get too deep into like what all those are, because this is not an entire course. But essentially on the S&P 500, which you'll see here, right? These credit spreads that I've been doing are, I'll pull up an example. So essentially on a credit spread, what I would do is, let's say, so S&P or the SPX is at $5,074. I'll pick an expiration date like April 11th. And what I'm doing is this is like a directional bet. I am betting in this case that the S&P will stay above 4,693, which is giving me margin for error of 7.5%, meaning like the S&P can crash up to like 7.3% and I'll still be in the money by April 11th. So that's only like what, 5 trading days. That's next Friday. Today's Friday. So by next Friday, if the S&P manages to not fall another 7.5%, I would make $700 on a $5,000 collateral, right? So risk 5,000 to make 700. That is like 12 to 15% in 5 trading days, which is amazing. So you'll see, I've closed 1 credit spread so far, which netted me $176, which I risked $2,000 to get. So that's like what, 17, 16% on my money. And I opened it April 1st and I closed it April 3rd. So in 2 days, I made 17% of that. Now, these are still open, as you can see. So I'll have to give you guys an update, but there's a good amount. There's like $1,500 I could potentially make in the next week and a half or so. I did some covered calls against my Tesla shares, which worked out amazing. Somehow I got lucky and timed it when Tesla was like at 278. Then tariff day happened. The next 2 days happened. This week happened. And I opened these again April 1st, closed them today, April 4th. So in like 3-4 days, I made about $1,000 just by hedging my Tesla shares. So that was nice. Yeah. Aside from that, I've made a couple of buys here and there. I opened a call option on Micron because Micron just got beat up so bad. Yeah, it took a huge beating. So I think I dated some call options to October of 2025 and just said, whatever. Like, Micron is it's getting close to having a price to book value of 1, which means it's trading at the same value of like the assets that it owns, which is insane. Its forward price to earnings is 10. It's just like basically a 1.5x leverage version of NVIDIA. So it kind of follows NVIDIA. But let's go to NVIDIA and see what their price to book ratio is. It's probably way higher. 30. So Micron is 1.5, NVIDIA's is 30. That means it's trading at 30 times the assets that it actually has, which is, Micron is basically 1-to-1, which is an insane deal. So yeah, I went long on Micron. A couple other names like Nebius Group had to pick up. Again, the semiconductor stocks, I'm trying to oh my God, we're almost 30 minutes in. Bullish on AI, just to wrap up this video. I'm bullish on AI, bullish on compute power, GPUs, everything AI, not everything AI in general, but energy. I'm bullish. Don't let people convince you that AI demand is falling or going away. It's only going up and to the right. And that's really it. Make moves. Don't sit on your hands. Now is not the time, right? Now is actually a time to let your hands free and start making some moves. We are doing that all day, every day in 444 Capital Club. So as you can see here, everybody's kind of, link will be in bio if you want to join us. But that is all I have. And yeah, I'll see you guys in the next one. Stay safe out there.